The secret war between banks and crypto. What if the biggest financial battle in the world wasn't happening on a battlefield, but inside the global banking system? Not with tanks or missiles, but with code. For more than a century, banks have controlled how money moves across the planet. They decide who gets loans. They decide who gets access. And in many ways, they decide who gets rich. But something unexpected happened in 2009. A new type of money appeared. Money with no bank. No central authority. No gatekeepers. Just code. And at first, almost no one took it seriously. But today, trillions of dollars flow through the crypto market. Governments are debating it. Banks are studying it. And some of the most powerful financial institutions in the world are quietly preparing for it. Because behind the headlines, a silent battle is unfolding. A battle that could reshape the future of money itself. And most people have no idea it's happening. But here's the real question. Are banks trying to destroy crypto, or secretly preparing to control it? Because once you start looking closer, the story becomes far more complicated. For years, banks publicly dismissed cryptocurrency. Some called it a scam. Others called it dangerous. And many warned that it would collapse. Yet behind closed doors, something strange was happening. Major banks were filing blockchain patents. Financial institutions were investing billions into crypto infrastructure. And some of the same companies criticizing Bitcoin were quietly building crypto divisions. So which one is true? Are banks fighting crypto, or preparing to join it? Because if you follow the money, a deeper question appears. Is this really a war between banks and crypto, or a race to control the future of finance? To understand what's really happening, we have to go back to how the current financial system was built. Because crypto didn't appear randomly. It appeared at a very specific moment in history. And that moment changed everything. For most of modern history, money has always had a gatekeeper. Banks. They store money. They move money. And they control the infrastructure that powers the financial system. Every time you send a wire transfer, pay with a debit card, or take out a loan, a bank sits somewhere in the middle. And this system has enormous power. Banks don't just store money. They create it. Through lending, banks effectively generate new money inside the economy. When a bank approves a loan, new money enters circulation. This system has fueled economic growth for decades. But it also concentrates financial power into a small number of institutions. And when those institutions fail, the consequences can ripple across the entire world. That's exactly what happened in 2008. A global financial crisis shook the banking system. Major banks collapsed. Governments rushed to bail them out. And millions of people lost homes, jobs, and savings. Trust in the financial system cracked. And in the middle of that chaos, something unusual appeared online. A white paper written by someone using the name Satoshi Nakamoto. It described a new type of money. A peer-to-peer electronic cash system. No banks. No central authority. Just a decentralized network verifying transactions. That idea became Bitcoin. And at the time, it looked like a small experiment. But experiments sometimes become revolutions. At its core, Bitcoin introduced something banks had never faced before. A financial system that didn't require them. For the first time in modern history, people could send money directly to each other anywhere in the world. No bank approval. No intermediaries. No central gatekeeper. The network itself verified transactions. And that changed everything. Because banks earn enormous revenue by sitting in the middle of financial transactions. Payments. Transfers. settlement systems, cross-border wires. All of these generate billions in fees every year. But blockchain technology showed something radical. Money could move without that infrastructure. Without banks verifying every step. Without financial institutions controlling the rails. And that raised an uncomfortable question inside the traditional banking world. What happens if people no longer need banks to move money? At first, the industry didn't take the threat seriously. Crypto was small, volatile, and often associated with online speculation. But then something unexpected happened. Bitcoin kept growing. As cryptocurrency adoption expanded, banks faced a dilemma. Ignoring it was no longer possible. But embracing it openly was risky. Because if decentralized finance succeeded, it could weaken the very system banks depend on. So, a new strategy quietly emerged. Study it. Invest in it. And if possible, adapt it. Some of the world's largest banks began experimenting with blockchain technology. They built private blockchains. They explored tokenized assets. They researched digital currencies. At the same time, governments and regulators started paying closer attention. Central banks began exploring their own digital currencies, known as CBDCs. Central bank digital currencies. These would look similar to crypto, but remain fully controlled by governments. Which created an unexpected twist in the story. The institutions crypto originally aimed to bypass were now building their own versions of it. But here's where things get even more interesting. Some banks didn't just study crypto. They began investing heavily in the ecosystem. Crypto custody services, blockchain settlement systems, digital asset trading desks. The same financial institutions once calling crypto dangerous were quietly positioning themselves inside the industry. Which raises an uncomfortable possibility. Maybe the real battle isn't banks versus crypto. Maybe it's about who controls the next financial system. To understand the real conflict, you have to understand what crypto actually represents. At its core, cryptocurrency challenges one fundamental idea: control. Traditional finance operates on centralized trust. You trust banks to hold your money. You trust governments to issue currency. And you trust financial institutions to process transactions. Crypto flips that model upside down. Instead of trusting institutions, users trust mathematics and decentralized networks. The blockchain records every transaction. Thousands of computers verify it. And once recorded, the data can't easily be altered. This creates a financial system that operates without a central authority. And that's revolutionary. But it also creates tension with existing financial institutions. Because banks rely on central control. They monitor transactions. They enforce regulations. And they operate within tightly managed financial systems. Decentralized networks don't fit neatly into that structure. So, the real war between banks and crypto isn't always direct conflict. It's a clash between two different philosophies of money. One system built on centralized trust. The other built on decentralized verification. And right now, both systems are evolving at the same time. Banks are experimenting with blockchain. Crypto companies are building financial services that look increasingly similar to banks. Decentralized exchanges, crypto lending, stablecoins, digital payments. The lines between the two worlds are slowly blurring. Which means the future might not be a total replacement of banks. Instead, it could become a hybrid system, where traditional finance and decentralized networks coexist. But that future is far from guaranteed. Because powerful forces are still shaping how this technology will develop. Despite its promise, crypto also comes with real risks. Extreme volatility, security vulnerabilities, regulatory uncertainty, and large-scale scams that have damaged trust in the industry. Several major crypto companies have collapsed in recent years. Billions of dollars in investor funds vanished. And critics argue that the industry still lacks safeguards found in traditional finance. Banks also raise another concern: financial stability. If decentralized financial systems grow too quickly without regulation, they could create new types of economic risk. Governments worry about money laundering, tax evasion, and the possibility that cryptocurrencies could weaken national currencies. Because if people begin storing wealth outside the traditional financial system, governments lose some control over monetary policy. And that's a powerful reason why regulators are paying close attention. Some countries have embraced crypto innovation. Others have banned or restricted it. And many are still deciding how to regulate the industry. Which means the next decade could determine whether crypto becomes a mainstream financial system, or remains a niche alternative. But one thing is clear: neither banks nor governments are ignoring it anymore. For thousands of years, money has evolved alongside technology. From gold coins, to paper currency, to digital banking. Each transformation changed how power moved through the economy. Cryptocurrency may represent the next chapter of that evolution. But the outcome is still uncertain. Banks remain some of the most powerful institutions on Earth. They control trillions of dollars. They influence governments. And they operate the infrastructure of global finance. Crypto, on the other hand, represents something radically different. A system that exists outside traditional financial control. A network owned by its users. A new experiment in how money could work. The real question isn't whether banks will disappear. And it isn't whether crypto will replace them overnight. The real question is who will shape the next financial system. Because right now, behind the headlines, behind the market prices, and behind the debates on regulation, a silent transformation is already underway. A transformation that could redefine how money moves across the world. And if history has taught us anything about financial revolutions, it's that the biggest changes often begin quietly. Long before most people realize what's happening.